Good morning, good afternoon, good evening, everyone. Thank you for joining today's webinar. This is a very exciting time in oil markets, to say the least. Our discussion today will be on the US-Iran conflict and the impact on refined product markets. We have a great conversation today lined up where we're going to touch on various facets of this conflict and how they've impacted refined product markets across the board, both on a regional basis and specific fuel markets basis. Obviously, this conflict is evolving very rapidly, and we'll try to give you an overview of how the state of play is as of today and where we go from here on the downstream side of the business. Before I get started, a few kind of housekeeping points on the antitrust. Again, S&P Global Energy, we're committed to full compliance with all antitrust laws, and anything you find in this discussion today is subject to those restrictions. In terms of the webinar, this is a fully streamed webinar with audio and video options. There might be some pop-ups on the screen, so let us know if you have any other technical questions. Please drop them in the Q&A box on the right. Any other content-related questions, feel free to also use the Q&A box and let us know if there's any issues or problems. We will answer them either during the flow of the discussion or at the end of this presentation. We'll have a Q&A section. The slides presented today will be made available to you. So reach out to us if you don't have them or see them, and we'll be happy to send them across. To jump into today's discussion, so today we have three great speakers joining me for this conversation. So my name is Karim Fawaz. I manage our global fuels and refining short-term outlook. I'm joined today by James Simpson, who leads our global aviation fuels, and he'll be talking about the state of the jet fuel market, where a lot of the pressures over the past week have been at their apex. In terms of both prices and the frenzy in the fundamentals. I'm also joined by Eleanor Buds, who leads our European fuels and refining research on the short term, and Kendrick Wee, who leads our Asian fuels and refining, and he'll also cover the Middle East kind of regional trends and what we're seeing in terms of the market as of today. So in terms of the flow of the discussion, we'll start out with a global overview and then jump into jet specifically, since that's where a lot of the pressure is in the short term. And then from there, we'll move into, I would say, Middle East and Asia, and then circle back to Europe and Africa and kind of go through a brief tour of the range of impacts so far and where do we go from here and what are the kind of key risks to think about as you're looking at the refined product markets going forward. So to jump right in about where we are today, this is a very fast evolving situation. Obviously, headlines are coming in fast and furious on a near daily basis, from refinery attacks to production cutbacks to refinery run throttling to government measures. So staying on top of that is kind of what we're doing on our side. We're trying to stay on top of all the changes that are happening and constantly reviewing both our outlooks and the market impact. So as we stand here today, just to start off, obviously, we are in an unprecedented time, and kind of the way I've been framing it is, in a decade full of unprecedented, this is probably the biggest physical disruption risk, really, that we've had as far as I've been covering this market. On the crude side, we've spiked up. We spiked above $100 a barrel yesterday. We've come back down. Obviously, it's a very volatile price environment on the crude side that's continuing to be a defining feature of this cycle. On the refining side, crack spreads have also followed suit, especially in the kind of middle portion of last week. We saw most global benchmarks surge to multi-month highs, testing really back to 2022 kind of post-Russia invasion highs. The driver of that upward pressure on the refining side has been largely on the middle distillate kind of part of the barrel. As expected, that's where most volumes coming out of the Middle East on the refined product side are located. And that's where the pressure from a global balance standpoint for refining is at its highest. So we've seen cracks move up. They've come down slightly since then, but they remain quite elevated by historical standards. And the longer this conflict goes, the more impact it will have across the barrel from crude down to refining as these effects kind of continue. The fundamental assumption that's key here as you think about the oil market again is still Hormuz and flows through the Strait. As of today, so this was updated yesterday, as of today, we're still seeing a very low level of vessels crossing the Strait of Hormuz. A few tankers made it through yesterday, some with AIS turned down, some Iranian tankers have still been transiting through the Strait. But by and large, for practical global oil purposes, the Strait of Hormuz is still mostly closed. And we're going now into the second week of that closure. This is already longer than a lot of people expected when this conflict started a bit over a week ago. And there's no sign as of yet that the proposed measures to help reopen the strait, whether it is US insurance guarantees or a military kind of or naval escort of vessels through the strait, has given any kind of likelihood of, in the short term, kind of breaking this deadlock. So as of today, we continue to be in an environment where the strait is very much closed, and the market is forced to adapt with the implications of that. It started to back up into the upstream side. We've heard a lot of cuts to production over the past couple of days, and on the refining side through runs and run cutbacks. So what's at stake? Why does it matter for refined product markets? Obviously, it matters for crude. Everyone knows why Hormuz matters for crude. But on the refined product side, it is much larger than markets have given it credit for. And I think we had a glimpse of that last summer during the 12-day war. And we're seeing that again as we see that today. So what's at stake? There's roughly 6 million barrels a day of refining capacity within the Gulf, 43 refineries. Out of those 43 refineries, they're responsible for nearly 5 million barrels a day of refined product exports. And it's quite importantly, it has become a core trunk line for certain products in certain markets. So it's been a core feed of petrochemical products into Asia, and that includes naphtha and LPG. It's become a major supplier of middle distillates to Europe and Africa. So both jet and gas oil flows from through Hormuz are core to those consuming markets, and the loss of that volume has sent each of those respective markets into a bit of a extreme tightness kind of risk and forced to find alternative barrels. Just for a matter of perspective, the two big numbers here in this chart I'm showing on the right hand side, it shows you as a percentage of destination market exports. The big ones on the product side are on the naphtha, roughly 50% of Chinese naphtha imports, but more importantly, 40% of overall Asia ex-China imports. So it's a very big feed into the petrochemical industry, and LPG is the same. On the jet side, jet into Europe is quite critical. Roughly 40% of European jet imports come from the Middle East. And similarly, almost half of African jet imports come from the Middle East via Hormuz. So volumetrically speaking, this is a real major physical disruption of refined product flows into the global system. And the longer this lasts, the more pressure will build across all of these destination markets and across, by extension, the global system. On a kind of volume basis, just to see over time how it's evolved. On the crude side, so you can see these two charts show you flow through Hormuz. On the crude side, we're averaging north of 16 million barrels a day of crude exports through the Strait. There's starting to be some redirection of crude into the global system. The two countries that have the ability to reroute volumes are Saudi Arabia and the UAE through pipelines that go to the Red Sea and to the other side of Hormuz, respectively. So we've seen Saudi Arabia ramp up flows through the East-West pipeline and loadings out of the Yanbu port on the Red Sea. So that's moved up around 1.5 million to 2 million barrels a day of incremental exports coming from the Red Sea route for Saudi Arabia. The pipeline capacity in the UAE to divert away from Hormuz is around 1 million barrels a day incremental. So it's around 1.5 million barrels a day total. So there have been some incremental kind of rerouting of flows away from Hormuz that can continue to find their way into the market. But even if you net those out, you're still significantly below, probably 2/3 of the way below flows prior to the shutdown of Hormuz on the crude side. On the refined product side, so I talked about the 4 million barrels a day earlier. In terms of, it's been steadily kind of hovering around 3.5 to 4 million barrels a day. This is refined products only. If you add LPG to these numbers, you move closer to 5 million barrels a day. Diesel in particular is kind of one of the major products on a volumetric basis, along with naphtha. Those would be the two kind of on an aggregate absolute volume basis. Those are the most important. On a relative basis, jet is quite important given its importance to regional markets. But it's not just the Middle East. So if you think about it in a broader sense, within the kind of range of where attacks have been unfolding, beyond strictly just within the Gulf and the Strait of Hormuz, you have 68 refineries in the general vicinity of this confrontation. If you include Iraq, the Eastern Mediterranean, and the Red Sea portion of Saudi Arabia, you're talking about 12 million barrels a day, or 12% of global refining capacity. But even more than that, if you start to factor in all the refineries that are processing crude coming from Hormuz, it brings it up to around 178 refineries there. 40% of global refining capacity in some shape or form processes crude coming via Hormuz. So if you think about it in a holistic way, almost more than half of the refineries in the global system are exposed directly or indirectly to what's happening here, what's been happening over the past week. So this is really a much broader conflict than just strictly looking at the flows through the prism of strictly what's locked within Hormuz. So how might it play out? So we've taken a scenario-based approach in our work over the past week. You've seen it in some of the reports we've published, and we've been publishing a lot of reports. We're taking it we're kind of separating our view within two major scenarios. A tighter supply scenario, which is the core assumption of that is a 2 to 3 week disruption of flows through Hormuz and a progressive normalization from there, but where you have limited temporary kind of disruption to refining capacity, limited demand responses. You're going to see significant acute spikes on the margin side on the short term, but progressive normalization after that. And a second scenario, which is an oil shock scenario, where you have a much broader confrontation, longer in duration, that takes volumes off the market for 2 months via Hormuz, and where you have harder, longer disruptions of refining capacity, run cuts around the world due to lack of crude availability, widespread demand destruction to rebalance the market, and you have a longer kind of period of strength in cracks and margin, and eventually potential downside as demand gets destroyed. As we stand today, I would say we're moving from that new base case, which is the tighter supply scenario, towards the oil shock scenario, at least in terms of magnitude on the front end. The key dynamic, or the key dimension of that oil shock scenario that still matters is the duration. So one of the core assumptions is of that oil shock has to last for a while. We're still in the early days, relatively speaking. It might feel like a long time, but we're only 10 days into this. If it resolves itself within the next week, I think it's one thing. If it lasts longer, we'd be kind of more significantly moving into that second scenario. So what does it mean for cracks before I hand it off to James to jump into the jet? On the interim base case, which I talked about, we see cracks spiking, and here I'm focusing really on the middle distillate cracks. We'll see cracks moving into the $40 to $50 range on the short-term side, so in March and April, before kind of progressively moving back towards our pre-war base case of around $10 to $20 a barrel by the back end of the third quarter of this year. So that's the profile. On the jet side, we see a more acute front-end spike, as we've seen so far, with cracks moving into the $50 to $60 range, and progressively kind of following that similar timeline, recovering back to pre-war outlooks by the end of the third quarter. In our oil shock scenario, we see a much kind of sharper rise and longer period of higher cracks lasting through at least the end of 2027. So on the diesel side, we see cracks moving into the $50 to $60 range, and then progressively eroding from there, but remaining in a $30+ crack world sustainably through the next 2 years. And similar on the jet fuel side, with a much more acute front end, especially for Singapore, where you've seen a lot of the pressure unfold. So you have Singapore cracks, and Kendrick will talk about that as we get to it, moving into the $70+ range So in an oil shock scenario, we can stay kind of very high for very long. Over time, demand will start to catch up with you and will be the balancing factor. But that will take time to play out in terms of refining if you have a significant loss of refining capacity in the system. So on that note, I would like to probably hand it over to James, and we can jump in first in the jet market, where we've had what we call the Great Hormuz Squeeze in terms of cracks and market impact, and we can go to regional discussions after that. James?
Okay, thank you, Karim. So I lead our aviation research, and in past oil disruptions, because these do happen relatively often, I tend to have it easy compared to my colleagues, because jet tends to be an afterthought. If you think back to Ukraine in 2022, it was all about diesel. If you bring it back to 2005, even with Hurricane Katrina, it was all about the gasoline supplies to the US. You're generally talking about one of the two primary motor fuels as the big driver of oil products. Yet in this case, it's jet. Now that's quite unusual. The reason for this is that, of course, as the title indicates, 80% of Middle East jet exports are actually located within the Persian Gulf, and they can't get out. Now, as Karim was showing for crude markets, you've got some pipelines across Saudi Arabia or through the Emirates that can alleviate to a certain extent, not very much, but at least you have a little bit of a safety valve there, and that there's spare capacity in these pipelines that can be used. Now, there isn't that for the oil products. So if Hormuz is closed, it becomes an autocratic bubble and nothing's coming out. Now what's really compounds the problem is that some of these Middle Eastern refineries have even specialized in jet production. If you see Kuwait in red here, you've got one refinery, Al Zour, of 615,000 barrels. It's a pretty big refinery. But what's particular about it is that this one refinery is supplying up to 10% of European jet. That one refinery, you knock that, even if you didn't have anything else, just that one refinery would be a problem. Of course, you're adding then Bahrain's refining and other capacities in the Gulf, and things really tighten up. Fortunately, there still is some jet production on the Saudi Red Sea. You see in Yanbu and Rabigh, and Oman, which of course being outside the Persian Gulf is able to continue production. But if you look at the numbers, of course, you're looking at around 120,000 barrels a day of jet from the region that's still being produced, where as opposed to almost 500,000 that's now being locked out. Now, where are these flows going? The biggest hitter is Northwest Europe. As mentioned, that one Kuwaiti refinery supplying up to 10% of European jet demand. If you add in the Med together, you're looking at over 200,000 barrels a day. And if you take the summer months when jet demand in Europe is the highest, you're well over 300,000 barrels a day. So, I guess some silver lining is that at least it hasn't happened in June, this disruption, because prices would be even crazier. This is comparatively, this is February, March is a time of year where there's less jet demand comparatively, particularly in Europe. But these volumes show you that the disruption is real. The second region that's affected is Africa. It's the second biggest in volumetrically, but Africa has the additional problem of not having much storage locally. So it's much more of a just-in-time market. And if you're cutting off supplies, suddenly you've got an immediate concern. Now, volumetrically, of course, Europe is by far the biggest importer of the products. These are Hormuz numbers, followed by Latin America and Africa. Now, Latin America, it's a non-entity because Latin America's supply is traditionally coming from PAD 3, the US Gulf Coast. So as much as they're seeing higher prices, they're not seeing any supply disruptions. Europe is clearly the biggest buyer volumetrically. When you put it as a share of demand, Africa is up there just like Europe. And as mentioned, they don't have the storage that Europe has. Europe doesn't have much of a buffer, but it has more than Africa does. The one saving grace for Africa is that it isn't bound by the sanctions that Europe has on Russian source crude, which you may remember were severely tightened last December. As a result, crude jet supply that was being Russian crude being refined in India, that was being then shipped to Europe. That has been all but choked off. There's hardly anything coming through from India anymore. Now these Indian volumes, they can quite easily switch to Africa. So in a way, Europe's issues actually become part of Africa's solution. In a way, there is a more obvious solution for finding incremental barrels for Africa. Europe really is the main concern here. So how much buffer do we actually have? Well, if you look at global jet stocks at present, it's not too bad. This you can see in green here at 2026. We started off in the middle range, if anything, pointing to the upper limit. The upper limit is in fact to a large extent set by jet stocks last year, where after the post-COVID rebound, where refineries were perennially short on meeting explosive demand. If anything, last year they overproduced on the jet, and there was more than enough jet fuel to supply to the market. But this year, it's not too bad. In fact, if you look, it's currently what it was before the crisis at the point where stock levels were in 2025. Of course, the outlook now is going to dip severely, and it's a question, as Karim's been pointing out, of how long this disruption lasts, and also if people react to it. Now, one way you can react is strategic stock holding. Now, you hear a lot of noise about the IEA, and are they going to release stocks? If you look in the details, different countries have different stocks. Now, the US has the single biggest amount of stocks, but they're almost exclusively crude oil. And Asian IEA members, such as Japan and Korea, that also have a lot of crude oil stocked. It's far more balanced toward the crude side than is jet. Now, the graph you're looking at here is specifically jet, so you have to bear in mind that this is not the totality of what IEA and other countries, IEA member states and other countries would have in storage. Most of it is in fact crude, but if you want to get product to market quickly, having actual product stocks, and specifically jet, is what you need here. And you can see them in blue. This is what's held in Europe. So and it's basically, with the exception of Korea and Japan, all the emergency jet stocks are held in European countries. And this is because it's part of EU legislation and obligation to hold so. But ultimately, you don't really want to be looking at how big the bars are. You could think China's got a lot of jet. That's not what really matters. Is what you see on the right here, the red diamonds, the days of supply, which are listed here. Now that this whole chart is ranked from left to right. The further you are on the left, the more in trouble you are in terms of days of supply. Now, China might have a lot of jet, but it has a lot of demand. That's a point of concern. On the other side, you can see PAD 3. Well, they've got over almost 3 months of jet storage. So when I mentioned Latin America earlier, the reason why they're not immediately at risk, it's because PAD 3 has plentiful jet stocks. But ultimately, this picture is not giving you the impression that we'll be able to hold out for long. Very few countries are exceeding 3 months here. And this is, of course, including commercial jet barrels that are already just in day-to-day operations. If you take the totality of EU stocks, or European in general stocks, strategic and commercial, you're looking at less than 2 months of storage. So it gives you an idea of how tight things could get if this disruption were to continue. Now, Karim showed these earlier, but it's perhaps useful to look at it again because it's specifically looking at the jet. If this disruption is resolved within another week, perhaps, the jet crack to crude will have spiked in the mid-50s and come down. If this prolongs itself, it will, you see the numbers are higher. You're in the 70s to 80 range, and it's more prolonged. You'll notice that it comes down just before the summer because we expect one way or another for there to be a resolution. I guess the most interesting takeaway here is that the highest cracks are in Asia and not in Europe. A lot of the noise around and a lot of the concern when you look volumetrically at where the jet's going and who's going to be cut off, Europe seems to be the most exposed. And yet the fastest reaction has been in Asia. Now I'll leave it to my colleague Kendrick to talk about the details of this, but it's very much brings us back to the initial point that is, it's not just a jet story, it's a crude story too, right? When you look at what's coming out of Hormuz, and with 85% of crude heading to Asia, that's their biggest concern. And also, I guess to wrap up, the biggest takeaway is, of course, that this is a very fungible and liquid world market. Europe's concerns, if they do start to run out, where are they going to be looking for those incremental barrels? One of the key regions is going to be East Asia. So if anything, Europe's problems are going to compound the problems in Asia, which help to explain the prolonged crack. And on that note, I leave it to Kendrick to delve in further.
Thank you, James. Yep. So my name is Kendrick Wee. I'm based in Singapore. So in the next 10 minutes or so, I'll cover the impact of the war in the Middle East as well as in Asia. Okay, so just let me start off with the kind of the impact that we have seen. Basically, here is the list of the energy infrastructure that has been impacted by the war. So there are a few categories on that. One of them is really preemptive. So there are some of the refineries being shut down because of some, I would say, not a direct missile hit, but some of the parts that came along with the missile. And then most of the shutdown are actually due to that. You see, we have this Israel refinery, Bazan refinery. We also have this Ras Tanura refinery also shutting down as a precaution, as well as we have some refineries that's because of some unreliable power outages, like the Iraq refinery that's shut down because of power offline. But then we also have a category of refinery that's down because of lack of product disposition. For example, Kuwait. You can see Kuwait actually here with we think that they have kind of reduced their runs by about a third, just because they are actually located in the Persian Gulf. So they have to kind of trim back their runs as well, not because they do not have the crude, it's because they do not have the disposition outlet. So I would think that broadly speaking, this war does not particularly, I would say, target oil infrastructure, but during a war, there can be some other, I would say, mishit, but some of the refineries actually did kind of close down because of precaution, and some of them are actually lowered their rates because they are unable to export their products. As Karim has mentioned earlier, around 4 million plus of refined products is actually exported out of Strait of Hormuz. So by closing it in an extended period of time, the storage tanks will start to fill up. And without disposition of the product, the refinery has no choice but to actually slowly bring down their runs. Sorry. Okay, so here is a graphic that shows the, I would say, the refinery assets, the key assets infrastructure in the Middle East, particularly zooming in the Persian Gulf. You can definitely see as what this James has mentioned. Al Zour is particularly a big jet exporter to the Europe. You can see that just on the bottom right corner, coming out of Kuwait, it's about 100 plus to 200 kbd of jet, fairly significant amount coming out from jet that's mainly go to Europe. And then we also have Sitra Bahrain refinery is currently down. That will also impact the jet flow out. I mean, of course, there's really not a jet flow out today because of the close of the Strait of Hormuz, but I would just say that the impact to Europe is fairly big just because this Strait of Hormuz is close. And then on the left-hand side, we have the diesel, fairly big exporter, but really jet is really the kind of a key product that's kind of we did see a very strong reaction, not just in Europe as well in Asia, particularly in Asia was such strong. It's because, as what James has mentioned, a lot of the crudes that's coming up from Strait of Hormuz actually goes to the Asia, which brings me to the next slide here. Goes to Asia, and as a result, Asia does export the jet. So without kind of a source of the crude or potential risk to the crude supply, this product would be at risk of lower production, lower exports, and hence the crack actually shoots up fairly quickly. And really, jet itself is fairly, and I won't say a unique product. Jet product is mostly is a straight run product, and it's really straight from the crude, which has a limited yield, right, compared to diesel and compared to gasoline. So there's really not a lot of flexibility. There's some flexibility by kind of cutting deeper, but really, cutting lighter to produce a bit more of jet. But there is from gasoline, but really there's really limited handle to increase jet production significantly. So looking at this chart here, basically is showing the amount of crude flowing through Strait of Hormuz, about 13 to 14 million barrels per day, right, 13.2. And then you can see that most of the crude that's flowing out of Strait of Hormuz actually goes into Asia, right? 70% here to Asia, and then to India is another 10 to 20%. So it's about 80 to 90% of the crude flows to Asia. So definitely on the supply front, there's really a big impact to the refiners in the Asia. And so the next few slides, I'm going to talk about from the supply side, which is really from the refining side would be the crude runs, what is the impact may be. So let's start with China. So China has actually, on the March 4th, they have kind of halt the product exports, right? Although the product exports is just a small fraction out of the entire, I would say, the refinery runs, but it's still a fairly significant volume based on the absolute level. So broadly speaking, we do have China exporting a fair bit of jet. About 50–60% of the Chinese exports are actually jet, and the other 20% is really diesel, and then the other 30% is gasoline. So on the chart on the left is really showing just the exports, excluding bonded exports. When I say bonded exports, it means that those international jet bunker, those are actually excluded in this number. And then, so where are all these exports actually going to? I would say for the most part, it's going to Asia, but there are some is going to Europe as well as North America. So North America, I would say particularly, the West Coast would be most impacted. But again, mostly this of the products are largely going to Asia. And the right-hand side, we do show the month-by-month product exports by product, by volume. Here, it could be a little bit small. We still see a fairly stable exports in March, just because a lot of them has probably agreed term up the exports out of China. So we will probably see a sharp drop in April rather than in March. And then this brings us to the point of, China halts refined product exports. In fact, it's not the first country in Asia to do that. Thailand was the first one, followed by China. And there are talks about so-called curtailing the amount of exports from South Korea as well. I mean, all this arises because, back to the earlier slides of that, we do as in Asia itself, imports a lot of crude from Middle East or via Strait of Hormuz. And without crude, it will impact the run rates for Asia refiners, and consequently for those net exporter of the refined products, those will also be impacted as well. So just from the net exporting perspective, right? So take, for example, Korea. So Korea has runs about 2 million plus, close to 3 millions. But a large part of their runs is actually exports out of the country. So you do see that around 52% of their, we potentially could cut, or at least Korea could potentially cut 52% of their crude, right? So this is a kind of a overview on what may be cut from the exporting point of view, the net exporting point of view. But of course, the other angle is that how about the countries or the market with net importers of products, right? So there are countries like Indonesia, Malaysia, Philippines, Vietnam, etc., Pakistan. Those are really net importer of products, but there also is a fairly sizable imports from the Middle East. So from a crude supply point of view, with the risk of lower supply, of course, there will also be a risk of run rate cuts. Just want to show you this graph here. I know there's a lot of numbers, a lot of bars, but we really want to show that, for example, just talk about Philippines. I know it's not a big, I will say, a refinery there, but you can see that they take about 78% of their crude is actually from Middle East. So this will likely mean that there's a high risk of Philippines refinery, the only refinery undergoing some run cuts. And then you also can look at, for example, Pakistan, Vietnam. Pakistan 92%, almost all is from the Middle East. Definitely also have a higher rate chance of rate cuts if they cannot secure the cargo. In Vietnam too, particularly in the Nissan refinery, a large part of it is really purely from Kuwait, right? So with obviously Kuwait is in the Straits of, it would be blocked, the exports. They will definitely face risk of run cuts as well. So going to the next point, another big market is really India itself. If you look at India, over the last few years, they have sort of diversified. Basically, they have taken a lot more Russian crudes. So the share of the Middle Eastern crude is actually reduced, but still, Middle East crude still made up of a fairly large share of the crude imports. So definitely with India, there also will be some sort of impact already. There's some announcement about rationing the supply. And if you remember, during the Russian-Ukraine war, I mean, if supply was an issue back then, but they do have a tool called the windfall tax. If actually some of the refiners are able to get secure crude, the government can use this tool to perhaps keep the products within the market. So they could implement this windfall tax to discourage exports of the products. But you can see in the middle chart, we do have a share of the crudes imports via Strait of Hormuz. So those with a higher share will definitely have a higher chance of run rate cuts. We do have similar lists also for China, but with the kind of a time we don't have that to share with you. But we do analyze refinery by refinery, see which one has a higher rate of run cuts. And this right-hand side chart shows the amount of exports. Certainly, there is room for India to cut exports, right? Its primary objective here, I would say, particularly for the state-owned refinery, is to meet the domestic demand. So there's certainly there's a risk for India to cut runs, and furthermore, the kind of commercial stocks in India is not that a lot. So it's a matter of time, could be soon, in another week or two, maybe before they start to kind of trim their runs. Okay, with that, I will hand over to Eleanor, which will bring you through Europe and Africa. Eleanor, please.
Thanks, Kendrick. Okay, so we're going to look at Europe and Africa, which are two main importing regions. Now, James has talked quite a lot about the jet fuel risk to Europe and Africa, so I'm only going to focus on the other product that these regions import significant volumes of, which is diesel. Gas oil, diesel, so gas oil for industrial use, shipping, some heating oil as well, and then diesel particularly for road use in Europe, clean diesel, which actually constitutes most of the product that Europe obtains through the Strait of Hormuz from the Middle East. So I'll just move on to the next slide. So what you can see here essentially is just an overview of the diesel exports that come through Hormuz. You can see quite clearly on the left-hand chart that the kind of blue and the yellow colors there are sub-Saharan Africa and Northern Europe. So that really, you can see that that kind of constitutes a very large volume of the diesel that's coming through Hormuz is going to these destinations. And on the right-hand side, you can see the share in diesel imports. So Karim talked about this briefly as well, but just to kind of reiterate that Europe, you've got kind of 10 to 13% of Europe's diesel imports are coming through the Strait of Hormuz. That equates to around 5% of demand, which is a really significant part of demand. And then for Africa, it's even higher. So about 19% of their diesel imports for the whole continent, covering about 18% of demand, comes through the Strait of Hormuz. So these are big volumes we're talking about, and they're volumes that are really significant if they, start to not arrive in these regions. It's of note that the European share has risen since the 2022 kind of post-sanctions, the Russian war in Ukraine, because Europe used to get a lot of its diesel from Russia, and that option not being open to it anymore exacerbates the whole kind of supply situation with diesel and the tightness, and then the kind of difficulties when another kind of source of supply is cut off. So these are two regions that are particularly vulnerable to a prolonged closure of the Strait of Hormuz and a blockage of the shipping coming through there. Now, on Europe, so Europe's a very large consumer of diesel. About 40% of the passenger car and van fleet is still running on diesel. Used to be a lot higher, but now it has fallen. But 40% is still running on diesel, and about 95% of the trucks run on diesel. So that's, a very significant demand share in transportation. Europe is short on diesel and gas oil. It doesn't produce enough in its refining system to cover all of demand, which is why it imports such high volumes. Now, since the Russian volumes are not coming to Europe anymore, it has to go much further afield. That would be the US. It would be particularly the Middle East. So Europe's very reliant on imports, and any perceived risk to this causes something of panic in the market. Now, you can see this if I go to the next slide. On the left-hand side here, you can see the reaction of the kind of main product crack spreads. So I know we've looked at crack spreads a few times, but it is worth kind of pointing out that the two kind of products at the bottom there, gasoline and fuel oil, they've risen, but there hasn't been a massive reaction, particularly gasoline. And then you can see the two products, jet fuel and diesel, that have had this really strong reaction to this threat to supply. And so that shows the kind of perceived risk. Now, since European sanctions not allowing the import of Russian products, there's been what we call a risk premium on the diesel price, the diesel crack spread in Europe, which essentially means that market fundamentals don't have to be particularly strong. Demand has broadly in Europe been declining. We don't see a lot of kind of strength, demand growth, particularly in this product. However, despite this, crack spreads have been pretty high, and that's part of a risk premium, which is the market perceiving a risk to supplies, because supplies are further away, and they're coming sometimes from regions where there's a risk to those supplies, as we saw a couple of years ago, and since a couple of years ago with supplies coming through the Red Sea, which were also subject to difficulties and rerouting and longer journeys. So this kind of risk premium is not new for European diesel, but because of the large volumes coming through and then the difficulties with other supply sources, this is kind of caused an even stronger reaction to the crack spread. Now, on the right-hand side, the chart you can see here is like the one James showed for jet fuel, strategic stock and stock level charts, but this shows it for diesel instead. So you can see that Europe is quite well supplied in diesel stocks. So there's quite a buffer. The red dots there on the chart show you the days of supply that are covered by these stock levels. So it's varied quite widely by country, but it's of note that some of these countries that might have lower days of supply are quite large refining markets, so they're able to produce diesel domestically to feed into that supply. So we've got a few countries with low levels of days of supply, and that does lead into greater supply fears and higher prices. So essentially there is a buffer. There's an emergency buffer of strategic stocks, and there's also a buffer of built up standard stocks that can be brought into use before any shortages, any actual physical shortages might happen. So that's kind of looking at Europe. Now looking at Africa, the story is quite different. So similar in a very strong kind of import dependence. It does vary very much depending on the part of the continent in Africa. So the east and the south geographically are much more exposed to a stop in Middle Eastern exports. The north and the west at the same have more refining supplies, more of their own refining industry, and then also closer links to European markets, so they're not as exposed. And this chart you see here on the right, showing the share of main product imports, jet fuel, diesel, fuel oil, are notably high there, so that's a kind of high dependency. But if you break this down, which I'm not doing here in the interests of time, but if you break this down by region in Africa, you'll see that, yeah, the dependency levels are quite different on the region and the country. Another point about Africa, we've been talking a lot about emergency stocks and generally stock levels providing a buffer against physical shortages. Now, a lot of countries in Africa don't have emergency stocks. Most of them don't have emergency stocks, and generally quite low levels of other commercial stocks. So there isn't a big buffer in many of these countries, and that can lead quite quickly to physical shortages, like faster than it would happen in a lot of European, US, Middle Eastern, or Asian countries. The other vulnerability in Africa is that there are some countries that really lack kind of logistics, easy and quick ways of transporting product around. So alternative transit routes are not always possible. That can also exacerbate the possibility of physical shortages happening faster. The other issue in Africa can be price in a lot of African countries. Foreign exchange swings, and then you get the kind of the very high European prices that will kind of price a lot of those countries out of the market for diesel. So that can, you know, in the past when we've had foreign exchange swings like that, you can see that there's been a kind of very, very strong movement in price, very high price rises, which then ends up eroding demand because it erodes affordability quite quickly. Now, what Africa has that Europe doesn't have is access to Russian exports. So Europe is, as I've mentioned, is not allowed to import diesel from Russia, but Africa can. So that is one element that can kind of relieve that competition for exports, that competition for kind of attracting exports away from the very high prices in Europe. So that could alleviate some of the strain in this kind of scramble between importers for extra supplies. So to look at the margins, that the kind of refining margin response to all of this. So Karim has showed the different scenarios that we've been putting into kind of use here. So here you can see our pre-war forecast, which we published, or the March forecast, we published at the very end of February. That's in the red line. Then you have the base case in yellow and the kind of oil shock, the high case in blue. So you can see that, and you've got hydrocracking margins, so kind of diesel linked margins, and then FCC, which is sort of more a gasoline linked margin. So you can see that in the base case, we've got a very strong spike in margins, but that it normalizes fairly quickly. So it goes back quite quickly to our former base case, our former forecast. And that's because if the closure of the Strait of Hormuz is relatively short-lived, there is this big disruption, but it doesn't last very long because those supplies come back to the market pretty quickly, and everything goes back relatively to where it was before. Now, on European diesel, you still have this risk premium in there. As long as there's a risk perceived to supplies, that will add to the crack spread. It will add to the margin. In the blue line here, the high case, which, as Karim noted, we're moving closer towards as the time goes by, and the Strait of Hormuz is still more or less blocked for pretty much all oil cargoes. You can see that it spikes up a little bit higher in the short term. But actually the most notable part is that it stays high for longer. So it's the duration really that puts that risk to supplies, that means, a kind of just a longer risk of physical shortages, a risk of much higher prices, a risk of demand erosion eventually. So that is the kind of key difference between the scenarios is the duration of disruption. So to conclude, we'll have a little look at some of the potential kind of outcomes for these two regions. So for Europe, the diversification of supplies. I mean, Europe, as I've mentioned, has relatively few options left. The US, the PAD 5, US Gulf Coast, in our analyses can raise refining runs a little bit, can provide some more diesel. Stocks are relatively robust there. They can provide some more diesel to Europe. So that's one option. But yeah, Europe is pretty dependent on supplies coming from the Middle East. There's India, Turkey can also supply some diesel into Europe if they're not refining Russian crude to make that diesel. So we're likely to see some kind of diversification of supplies. Strategic stock releases, as we discussed, are possible if the situation is starting to look worse. Government price support at the pump, so very high prices. This happened in 2022 when the prices got really high. There's a couple of countries we've heard reports that are cutting tax rates already. So that is kind of a consumer help measure to ease the impact on consumers. That can sort of artificially raise demand though. So that sort of doesn't help the overall picture if we're looking at a short, tight market. We can then go into, as we've mentioned, physical shortages, potential rationing. Could there be demand destruction if prices remain high? That's a definite possibility. We've been asked about potential loosening of sanctions on Russian products on the European side. That would probably, in our view, be quite a drastic measure. That is not something that would happen easily. I think the situation would have to get a lot worse before that would be put into place by the EU. And there is a kind of small upside to this is the margins that we looked at. So there's an upside for European refiners as margins rise. Competition from imports is lower, and European refiners that can raise runs that can keep the refineries running strongly will see much more demand, less competition, less exposure to exports, and an upside for margins there. In Africa, so again, diversification of supplies, so they could get more possibly from Singapore, from India, and then internally from the Dangote refinery in Nigeria, which is ramping up post extensive maintenance. But we're likely to see an increase in import costs, so that could lead to very high prices, unaffordability, and then potential demand destruction there. Likely to see more Russian imports, as we mentioned. Again, same as in Europe, if we can't get the product in, there could be physical shortages and some rationing. likely rise in black market sales as well. Would be a big temptation there with high prices. And then more particularly to Africa, there could be some delays in phasing out of subsidies, which is something that many countries have been trying to do. Upsides a bit again for kind of exporters, so exporters of LNG, exporters of oil products in West Africa, in North Africa, and South Africa as well, could definitely see some upside there. So that's the kind of view from the sort of big importers of diesel. Yeah, to conclude, very, very vulnerable to any longer closure of the Strait of Hormuz. So with
Thanks.
that, I think we can go to take some questions, and I'll hand you back to Karim.
Thanks, Eleanor. I think vulnerable is an understatement here at this stage, just given the scale of what we've seen so far. We have a few minutes left here. We've had a lot of questions come through the chat. We've tried to answer some of them as they've come and through the flow of our discussions. But maybe kind of I can group a few of them under a couple of high-level questions here. On the SPR side, I think, James, you had kicked us off. You had that discussion within the jet context. But maybe more broadly, you have some experience in the topic and looking through it over the years, just in terms of what can be expected from the market, how fast can these volumes be released, do crude stocks matter as much in the current type of disruption context versus other types of disruption historically? So how can it help us think through the SPR, or the strategic stocks rather, I think is a better way to call it.
Yeah, well, one advantage of holding product is that it is generally already within the system. It's not necessarily, in almost all cases, the European strategic reserves of it, whether it's gasoline, diesel, or jet, it's held because there are obligations placed on the operators. So it can be an airport, it can be fuel retailers, and so they're holding it wherever they want in the country, and they tend to hold it as parts of their operational stocks. So when the obligation is lowered in the case of a crisis, these stocks could be made available really immediately to the market. It's basically the operator, and everybody jumps at the occasion, because with high prices, you can actually, obviously, sell it for, make a greater profit. So there's no reticence to go there. So that's this is speaking based on, I used to work at the IEA in the strategic stocks department. So in terms of speed of response, there's no doubt that the stocks that are being held across Europe of product will be brought to market quicker. Now, crude stocks, they're equally effective, particularly when you're doing it for disruption on longer term. But of course, you first need to tender the stocks, and then after the sales, they actually need to be refined. So in terms of length, there's it of course takes longer than holding existing product stocks. Maybe leave it there, given the timing.
Yeah. Thanks, James. Maybe I think we're kind of coming up on time, but I do want to kind of squeeze in maybe one last question here about kind of how to think about duration in the context of how long it takes for things to normalize. And this is kind of one of the challenges with this conflict. And it's a good question. We've had a few variants of it, which is how long does it take for things to go back to normal? And the issue here is really nonlinear in the sense that if we go an extra week longer, it takes an extra week to bring back up. That's not quite the way it will end up working, especially as we get into the next few weeks. If we continue to see this flow disrupted completely, certain things will take longer to ramp back up. If run cuts get deeper, refineries have to cut runs across the board. Those supply chains start to break, and it can take a lot longer for that flow to normalize. So I think there's two parts of that question. Part of it is on the refinery side, on the technical kind of and operational side of refining. I don't know, Kendrick, if you have any insight into that in the context of Asia, since you're seeing some run cut news. How fast can these refineries come back up once the strait reopens? Is there a good rule of thumb to think about for if it ends this week, is it a month or 2 months before things get back to normal, or I mean, how should we think about duration?
Yeah, good question, Karim. I think there are nuances between the refinery that is being offline in the Middle East and or offline or run cuts in Asia, right? So once the Strait of Hormuz is normalized, for refining in the Middle East, they could directly get the crude because they're near to the crude. In fact, it's most of the time it's their own crude. So they could actually, if their crude production can ramp up quickly, they can quite easily fed that into their own refineries and then start to run the refinery, starts to produce the refined products and exports within probably one to 2 weeks, probably. However, on the other end, in the Far East, right, for Asia, it does take a number of steps for refined to kind of gradually get back their crude supply. First, the Asian refiners got to have the ships to line up, probably in a crowded jetty to load the crude. Right? First, they must find a tanker. Second, the tanker managed to find a berth to load the crude, and then after that, probably around 30 days, 45 days, depending where it is, to bring the crude over back to the Asia refinery. And even so, right, the timing of the availability of crude startup for the different Middle East producer can vary. So I would think that the refiner in Asia will take a very cautious step because each of them will have a different operating envelope, different recipe for their crude or crude mix or crude slate. So it could take a while for them to gradually ramp up. Probably after Straits of Hormuz is open up, it could take like perhaps 3 weeks to a month, probably at least. Yeah.
Yeah. Thanks, Andrew. I think the takeaway for me on the duration side is, at the stage we are in currently, where it's been 10 days, it seems like we've already gotten to the point where the recovery from where we are today will be longer. I think we've passed the stage where this can be a flash in the pan type 2-3 day disruption where flows can catch up pretty quickly to where they were prior to the conflict. I think we've moved into a different phase, which is at this point the system is starting to adapt to these cuts to flows, and it's having far-ranging impacts in the short term, and potentially that will be a longer kind of normalization process. So we're going to call it here. I mean, we're at the top of the hour, past the top of the hour. We've had a lot of questions in the chat. We'll try to answer some of them and follow up on some of them after this call. Feel free to reach out to us. We're going to bring up a poll in a second here with some questions in terms of if you want to reach out to us, if you'd like to discuss some of either our research or our content, please feel free to reach out to us. All of us are available and willing to help. These are very trying times, very interesting times from a market standpoint in terms of understanding all the things that are happening as this conflict goes on. And we'll continue to be publishing reports and doing some of these webinars in the coming weeks to stay on top of it. This is really a unique type of environment for us, and we're hopefully we can continue to deliver some of the insights that you're looking for as you think about this, the impacts on your business or your investments. Thanks, everyone, and talk soon.
Thanks everybody.
Okay, thank you.